Hello, Accounting 201 students. Welcome back. Today we're going to be covering Chapter 11, and my plan is to break it up into three different parts. Chapter 11 deals with current liabilities and payroll. And so I'm going to turn off my video and get to sharing with you the PowerPoint on current liabilities. And so stop the video here and get to rearrange. And so hopefully you realize that current liabilities are things that we owe within a 1-year time period. Right? And so if you remember, we talked about this before when we identified things as either current or long-term. Right? Current is anything that is due within 365 days or a calendar year or less. Right? Anything that's over that is considered to be a long-term liability, which is what we'll cover in Accounting 202. So current liabilities and payroll. Get to the right spot here. So a current liability, when a company or bank advances credit, it is making a loan, right? The company or the bank is called the creditor, right? And so we should be familiar with this terminology. Okay, so a creditor is somebody that we owe. The individuals or companies receiving the loans are referred to as the debtors because they owe the money. All right. Debt is recorded as a liability by the debtor. Long-term liabilities are due beyond 1 year. Okay, and so that means that current liabilities will be paid out of current assets and are due within a 1-year time period. Now, I do want to say that there is more to it than that, but really it's for our purposes, that will be the rule. Okay, when we get into intermediate, we're going to expound that definition just a little bit more. All right? But as it stands now, it's paid out of current assets and are due within a 1-year time period. So an example of that we've been dealing with all along, all right, are accounts payable. All right, and so whenever we purchase something, let's say it was supplies on account, accounts payable, okay, and let's just say it was $300, okay, we would have gone ahead and recorded, all right, the journal entry, supplies, accounts payable. Accounts payable is a liability. It's usually paid to 10 net 30 within a 1-year time period. Therefore, it's current. For most companies, accounts payable is the largest of all current liabilities. Then there's the current portion of long-term debt. The best way that I can explain this is with a mortgage or a car payment. I don't know if any of you guys have one of those two things. All right, but generally you have to pay your mortgage payment. Okay? So let's just say it was $1,000. Okay, you've borrowed $150,000. Okay, and so that's your monthly payment. Well, you're going to have to make 12 of those payments within the next calendar year, aren't you? Okay, and so that would be the current portion of the long-term debt, right? Because usually mortgages are 30 years, all right, or 15 years. All right, the remaining of that portion is not going to be owed until more than a year from now. Okay, and so what we're talking about are those 12 payments of $1,000 or $12,000. As far as reporting, we're going to record those as a current portion of the long-term debt. We're really going to spend some time today talking about, and this is going to be the bulk of the first part of this chapter, short-term notes payable. All right, and so notes may be issued to purchase merchandise or other assets. Notes may also be issued to creditors to satisfy an accounts payable that they credited earlier. All right, and so if you remember when we talked about accounts receivable and notes receivable, this is just the other side of that transaction. All right, and so if we purchase something on account, all right, and we can't pay it, the credit terms pass by. And so here's an example. Assume that Nature Sunshine issued a 90-day 12% note for $1,000. dated August 1st, 2007, to Murray for a $1,000 overdue account. See, Sunshine owed Murray that $1,000. All right, it might have been 210 net 30. Who really knows? But the 10 days went by, we didn't pay it. The 30 days went by, we didn't pay it. So finally, and hopefully I do recommend, if you owe somebody, it's better if you call them first in order to set up alternative ways of dealing with that liability. All right, it will just go better for you if you do it that way. And so that's what happened. Nature Sunshine, said, hey, I can't afford you that $1,000 right now, but let me give you my promissory note. All right. And so just like the chapter on accounts receivable, notes receivable, all right, we're going to have to calculate three things. We're going to have to calculate the due date. We're going to have to calculate the maturity value. And if you remember, that's the face plus interest. And then we have to make the journal entry. This, all right, is the problem from our exam number 3. All right. But in this case, instead of somebody owing us, we owe them. All right. And so looking at this, all right, the note matures. Okay. We have to first of all figure out the number of days. All right. And so it was a 90-day note. Let me go back and I'll actually I don't have space to do it here. All right. But if you remember to calculate the due date of a note, we started, all right, we have a 90 days. Okay. We started with August, right? And this was written on August 1st. There's 31 days in August, so we're going to subtract 30 days. Okay. And so 30 days from 90 gives us 60 days. Okay. There is no month that has 60 days. So right after that is September. September has 30 days. And so that brings us down to 30th, October 30th. That's the due date, all right, of this note. That's how we came up with October 30th. We calculate the interest, all right? Interest equals the face times the rate times time. Okay. And so that's what we did here. Okay, we had the face amount, the interest rate, and the time period. And because we use 360 days, we just take 90 divided by 360, okay, and we come up with, in this case, the interest of $30. But if you remember, maturity value is the face plus the interest, okay? And so this is our maturity value here. And so we report that interest, okay, interest expense in this case, because if you remember before, when it was an accounts receivable, notes receivable, that was interest revenue. This is an expense, and we record it in other expenses on the income statement. The interest expense account is closed as of December 31st. And so here's a transaction, all right? So again, this is from, what was it, chapter 9? I think it was chapter 9, okay, when we did receivables, right? So this is what we would have recorded because in this chapter, it's just the other side of the transaction. So here we have our asset, and here we have our liability. Okay. And so in this chapter, we are this Bowden, right? And so we entered into this purchase of merchandise on account. Okay, we can't pay that within its 30 days. Okay, and so we end up issuing them a 60-day note. Okay, so we reduce our accounts payable. This goes down, right, and this goes up. One liability for another, okay, for the 10,000, and then at maturity, okay, we calculated the interest. Right. So the interest was the face times the rate times time. And we added that, right, to the face amount of 10,000, or 10,000. And so we end up with a 10,200. And again, we made this journal entry last exam. That's my last expense. And so that's why I'm kind of flying through this, right? Because you should already know how to do the calculations. It's just learning the proper account titles, right, in order to accomplish this. A company, all right, could also borrow money from a bank and give them their promissory note. Right? And so here, assume that on September 19th, Iceberg Company borrowed cash from First National Bank and issued a 4,000 90-day 5% note to the bank. The entry is recorded as such. All right. And so when we have this information, the things that we need to calculate is the due date, right? And so we entered in this, all right, this is a 90-day. Okay. We entered into this on September 19th. Well, there's 30 days in September. Okay. And so we just take 30, subtract 19, right? And that gives us 11. So 11 days in September, right? And so we subtract that from the 90, and that brings us down to 79. Well, obviously no month has 79 days. So September, October, okay. October has 31 days. So we subtract that. That comes down to 48. All right. So October, November has 30 days. So December 18th is going to be the due date. All right. The maturity value of this note, right? First of all, we want to calculate the interest. Right? So interest, like I said, is face times rate times time. And so in this case, all right, we had the face amount was 4,000. Right? The interest rate in this case is 15%. And the time is 90 over 360. And so we just do the calculation, 4,000 times 0.15 times 90 divided by 360. And so we come up, right, with 150. But hopefully we know that that is interest expense, okay, whereas the maturity value, we're going to have to add the face, $4,000, right, giving us 4,150 as our maturity value. All right. And so with that information, we can make our journal entry, okay, where we, when we pay this off, we paid off in cash. That's the maturity value that we just calculated. We reduce the liability that we incurred back in September. And we record the interest expense with $150. This is what's referred to as an interest-bearing note, right? Because there are different types of notes that we'll have to account for. Right? A discounted note, right, may be issued rather than an interest-bearing note. Right? So sometimes these discounted notes are referred to as non-interest-bearing. So a discount note has the following characteristics. The interest rate on the note is called the discount rate. The amount of interest on the note, called the discount, is computed by doing the same thing, right? Face times rate times time. The debtor or the borrower receives the face amount of the note, right? And that's referred to as proceeds. Okay. So if it asks for the proceeds of a note, really you're talking about a discount. The debtor must repay the finance amount of the note on the due date. Okay. And so really what this is, okay, it's, you know, an interest-bearing note. It basically says we borrow and we pay back. And so with an interest-bearing note, what we've already done, we're saying, hey, we have this note, okay, and we're going to earn interest, okay, this way, right? Whereas a discounted note, we're saying, hey, we're going to pay back that amount, and we're still going to calculate the interest, but we're going to subtract that interest from the face amount and come up with the proceeds. Right? So this calculation of interest is the same thing. So hopefully they use the same numbers. They didn't. All right. But basically we're saying, hey, you know what? We're borrowing $20,000. We're going to pay back the $20,000, okay, in 90 days. All right. And so the cash that we're going to get today, all right, is going to be that $20,000 subtract the interest. How do we come up with that interest? Well, we had our face times our rate, right, times time. So the same calculations, but instead of adding that to the face to get the maturity value, we're going to subtract, right, the 750. We're going to subtract that to give us the proceeds. Okay. In this case of 19,250. Okay. Basically, we're prepaying the interest. Right? We're paying the interest expense up front, okay, on this transaction. Then 90 days later, okay, November 8th, okay, we pay back the 20,000. So we already recorded the interest expense. We're just paying back the face value of this discounted note. Cool. Well, we'll end there for this first part, and we'll come back to calculating payroll and payroll taxes on our next video.